At Enbridge, we monitor our pipelines around the clock, using trained operators and computer monitoring systems. Because for us, safety isn't just a job. It's a 24/7 commitment.
Please welcome veteran financial journalist and the author of The Message of the Markets, Ron Insana.
Thank you very much. It's great to be back with you folks. I guess Sandy gave you all the good news. So the Dow was up about 380 points just a little while ago, but there's been some reports that China has 4 warships around Taiwan, and we're down about 1,000 now. So there's been a big turnaround in the markets this morning. It's not true. I'm just making sure you're paying attention. It's early. No, I know. Listen, if you've spent 41 years in the news business, you could pretty much say anything you want in front of an audience, and they'll believe you. That's just kind of goes with the territory. No, just to bring you up to date on the actual news that's taking place this morning, as far as we know, there are some scheduled peace talks between the United States and Iran over the course of the next 24 hours. Although we're getting radically conflicting headlines from both sides. There's a 15-point plan that was presented to the Iranians via an intermediary that the United States has put forth. The Iranians are saying that they're not talking to the United States right now and that they have no intention of talking to either Steve Witkoff or Jared Kushner. We'll only talk to J.D. Vance. They've also said that they're not going to negotiate with us. Having said that, the Dow's up about 350 points right now. Oil's down about $3.50. So the markets are betting on some resolution to this. There are some, still uncertain elements as we move towards the end of the week. The 82nd Airborne has reportedly been dispatched to the Middle East. We have troops moving towards that part of the world, which is either a pressure tactic to get the Iranians to come to the table, or you don't usually move that many people and that much materiel if you don't have some intent on taking military action. So it's still an open question, a very fluid situation that has a lot of economic activity frozen in place, a lot of volatility, obviously, in financial markets since this has begun. The price of gasoline in just 1 month's time has gone up $1 a gallon on average nationally. And so in addition to some of the numbers that Sandy outlined with respect to inflation, the war has been net yet a further pressure on prices for not just energy products, but also things like fertilizer as we're going into the planting season. The lack of availability of nitrogen, urea, and other components of fertilizer are left wanting. A lot of that goes through the Strait of Hormuz, which is only now open on a toll basis, and Iran is letting friendly ships go through, but not ships that are associated with any adversaries. So there's still this problem of accessing commodities from the region, and that will persist for some time to come, even if there were a resolution by the end of this week. Reopening that, getting some of those products that have been, idled for the last several weeks will take some weeks, if not months, to restore. When you look at LNG facilities in Qatar that have been destroyed, they're talking about 3 to 5 years of putting those back together and getting them fully functional. So we're going to see some ripples through the economy that will last longer than just this military altercation itself, and will have probably some upward pressure, at the very least, on near-term inflation readings. Could keep the Federal Reserve from cutting interest rates. In fact, at the moment, the bets in the financial markets right now are it's as likely, if not more likely, that the Federal Reserve could raise interest rates this year than cut them. And so we've gone from 3 rate cuts at the end of last year expected for 2026 now to either no rate cuts or a possible hike, depending on where inflation numbers go from here. So as I've been, talking through the beginning of this year and even towards the end of last year, the way in which I characterize the environment in which we find ourselves today, and I think it's relative and relevant to what Sandy had to say before it. We're in an environment, and I'll use a movie title here, Everything, Everywhere, All at Once. We're going through so many different variables simultaneously. It's very difficult to make a cogent and cohesive forecast as to exactly how 2026 plays out economically and how it plays out in our financial markets. And that has to do with tariffs. It has to do with the war. It has to do with energy policy. The fact that there's $50 billion in stranded capital for EVs when we pulled the EV credit off last year and that $7,500 went away. I know one of our local Mercedes dealerships, which was transitioning to EVs, not only at the end of 2025, were they still selling as quickly as they could what they had on the lot with the $7,500 credit, they threw $4,000 on top of that just to get the EVs off the lot. At the same time, China is building EVs as fast as they possibly can at about $30,000 per car. They're building solar capacity as fast as they possibly can, enough that they could power the United States for a year. And in that regard, we're less competitive today than we were over a year ago, whether it was President Obama or President Biden. And President Biden. And let me just say, this is policy analysis, not personal preference. But when you look at energy policy, all of the above policies that have been in place for over 10 years were the right policies, given that we are now in an energy-related war that has made us even more dependent on crude oil, natural gas. And again, we are preeminent in those two spaces. We're the largest producer of oil in the world. We're the largest producer of natural gas. Those industries, natural gas in particular, may benefit from other parts of the world being offline, but only in the short run, not in the longer run. President Trump just offered to pay a French company $1 billion to shut down a wind farm. We're kind of going in the wrong direction when it comes to the energy policies of the United States. We didn't fill up the Strategic Petroleum Reserve at $55 a barrel back in January, ahead of our altercation, incursion, excursion, whatever word the president uses at this point in time for Iran. And so we find ourselves now having to look not only to our own SPR, but strategic petroleum reserves of the rest of the world to hold down, if we can, the price of energy both domestically and internationally. So from a policy perspective, it is extremely difficult to make, as I said earlier, kind of a coherent straight line forecast for 2026. The way I see things shaping out, and I saw this, I think at least I started to feel this late last year, is that we're in an environment, and Jay Powell would disagree with using this word, but it's almost a mini stagflation. We do have inflation that's above the Fed's target of 2%. It's hovering at around 3% right now. There'll be some upward pressure on those core numbers, and there'll be upward pressure on headline numbers because of the increase in the price of gasoline, other energy products, other commodities. Again, we're in the planting season with the lack of availability of fertilizer. That's pushing the price of things like corn and other agricultural commodities higher. And then at the same time, and this is not just here in Michigan, but you also see that the labor market in the United States across the board has stagnated. Since Liberation Day last April, when the massive reciprocal tariffs were announced but never implemented, we have not created net new jobs in that period. So our job market has effectively flatlined over the course of the last almost 12 months now. And so we have a weak labor market, relatively speaking. We have higher than expected inflation. Rather surprisingly, we still have GDP growth that's estimated this year to be above 2%. Now, part of that is what you heard Sandy talk about with respect to data centers and the infrastructure build out for artificial intelligence. That has been one component in growth, as has consumer spending, but that consumer spending has been concentrated among upper income individuals. So Moody's points out that the top 10% of wage earners in the United States account for 50% of all consumer spending, which is an extraordinary number. That split is quite wide. And the top 20% pushes it above 60%. And GDP is comprised of 68% consumer spending. So you can see that wealth gap is widening and the purchasing power is narrowing. And that leaves us a little bit vulnerable to the risk of recession. Number one, if the labor market were to weaken further, and two, if there were some adverse financial shock that would hit upper income individuals and force them to stop spending, you would run the risk of recession while inflation is still elevated. Now, it's not the 1970s by any stretch of the imagination. And again, one of the reasons that Jay Powell, in his news conference a little more than a week ago, cautioned us against using the word stagflation. Some of you are old enough to remember it, some of you are not. But in the 1970s, actually it started in 1966, but it went all the way through 1980 and 81, where inflation accelerated from around 3% all the way up to 13% at its peak in the early 1980s. Unemployment was 11%, and short-term interest rates were 20%. Right? That is a radically different environment than we find ourselves in today. But the environment that we find ourselves in today is also not terribly satisfactory for most Americans, particularly if you subscribe to the notion that we're in this K-shaped economy, where the folks on the upside of the income distribution are doing well and spending. Those who are in the middle are keeping pace with inflation, and those who are on the downside who've been affected by the affordability issue, the abandonment of the ACA subsidies, and other issues that have supported them. After the midterms, there'll also be about a $900 billion cut in Medicaid and food stamps, which would further exacerbate that gap. It is an extremely uncertain time, and the policy mix is such that at least in the short run, we don't see a lot of relief from this condition. The Federal Reserve cutting interest rates would do very little to boost employment because a lot of what's going on is structural. We were seeing that with new graduates out of college, they're having a difficult time, at least anecdotally, finding work. It appears one of the mistakes that we made as parents of, in my case, Gen Z kids, thankfully I didn't do this, but others have. Over the last 8 years, we've recommended that most kids learn how to code. And if you talk to the CEO of NVIDIA, if you talk to Microsoft, you talk to other companies, AI is going to be doing the coding, not the kids. Right, so they're struggling to find jobs. Software engineer hiring, however, has gone up because you still need people to supervise artificial intelligence protocols that are being developed. And so there's this very, kind of strange mix of employment opportunities and employment that's going away as we go through this technological revolution. This is not, by the way, unique to this particular environment. Every time we go through a technological revolution, we both lose and gain jobs. The difference here is that when you hear some of the CEOs in the artificial intelligence community talk about this, they're talking about wiping out entire classes of employment, whether it's paralegals who would take days to summarize and analyze briefs and turn those back to lawyers. That can be done in a matter of hours now with an artificial intelligence agent. If you're talking about the financial services industry, some of the back office activity that's taken place that allows FAs or financial advisors to interact with their customers, all of that can be automated. They're talking about it in healthcare and a wide variety of industries. Some are even suggesting that 50% of white-collar jobs could disappear over the course of the next 1 to 5 years. Now, what comes in its place, we still don't know. And again, as was the case with every other technological revolution, we don't know the jobs that are yet to be created. That was true when we were industrializing, and Detroit was the biggest beneficiary of that at the turn of the last century. When mechanization, when industrialization, when the automobile came, you may not be familiar with this, but in 1895, there was a massive bubble in the production of bicycles. People thought that was the new mode of transportation that was going to be wildly transformative. By 1905, 1,000 different bicycle companies went out of business except for a few because automotive development was so fast and so profound that it had an enormous impact on not just different industries, but certainly on different parts of the country that benefited from that boom. And now you're seeing different parts of the country benefit from the artificial intelligence boom, whether it's Silicon Valley. Obviously, if you're building out data centers here, that is both it's a benefit to some in communities. They may find it a burden. There are environmental concerns, heat concerns, and things like that that have caused some communities to oppose the build out of AI data centers, but that's more in the minority than the majority. The reality is that what's taking place there is transformational. It is quite large. And the question is, will there be shared prosperity that goes along with it? Obviously it's had an impact on equity markets, although we've seen some of the bigger companies that are involved in artificial intelligence, trade down in the market because they got richly valued. We've seen a bit of a pullback in stocks since the start of the war. We had a 10% correction in the Dow, the NASDAQ, and the Russell 2000 as of last Friday, and we've since bounced off that lows. So we have, again, a wide variety of cross currents that, suggest we will muddle through for the remainder of this year, barring any unforeseen circumstances. If there's an expansion of the war, that is going to complicate things rather dramatically, I think, with respect to affordability, with respect to the way inflation looks, how Fed policy evolves from here, and how, generally speaking, policies out of Washington evolve as well. The tariff thing we are kind of stuck with. Even though the Supreme Court ruled against reciprocal tariffs, the president is putting Section 301 and Section 122 tariffs in place to replace those, and so we're still paying for them. And at this point, as many as 150 companies have sued the government to get somewhere between $130 and $170 billion back. That may or may not happen. Treasury Secretary Bessent said that's not going to be a feature of the landscape going forward. So that's somewhat problematic for companies that have had to pay those tolls, if you will, and obviously you felt it here rather profoundly. I think going forward as well, beyond that, there are some other issues outstanding, and some of them are regional, some of them are national, but not the least of which is we have, beyond geopolitical issues, economic issues, we will have some political things to keep a close eye on this year. The midterms are coming up. If you look at the polling right now, the House would be swept by the Democrats, and there's even polling that would suggest Democrats could take the Senate on a 52-48 margin currently if things were to stay the same. Without any benefit, without any break in the affordability crisis and with some of the policy mixes that we have going on right now, people are generally uncomfortable, as uncomfortable, quite frankly, as I've seen them in quite some time. I mean, the pandemic was one thing, the great financial crisis was another thing. This seems to be a persistent kind of gnawing type of pain for a lot of consumers and citizens, broadly speaking, that's just a little bit different than some of the things we've experienced in the recent past. We've had crises, we've come out the other side stronger. This seems to be more of a nagging problem that people at the moment are not easily escaping, and so that has changed, as you saw earlier, and developed and created a large impact on consumer sentiment, which is not that easy to change unless policies were to change dramatically and the overall economic reality were to shift dramatically over the course of the next 6 months. So all of that makes, again, this a very difficult environment. From my perspective, I mean, it's hard to forecast the stock market where you have, again, this number of variables. And then the one that I haven't spoken about yet, and we talked a little bit about this earlier, is private credit, which may or may not be in a bubble. And when we look around, the financial community, we see that there's been a lot of credit extended. There's been about $3 trillion raised in the last several years that's gone to work in, lending to companies, some of which are private, some of which are public. And what we don't know is whether or not, given that it's an opaque market because it's private, whether there are some rabbits in the woodpile that at some point along the way are going to jump out and create problems in the financial markets, the public financial markets, and have some negative impact on the banking community as well. It's not 2008. I don't think it's that big. I do think it's big enough to shake the tree or create a moment in the financial markets that would upset people and certainly get them a little bit unnerved about the state of affairs when it comes to those things. Not every credit is AAA. And when you have $3 trillion to put to work, you can't just lend to the top of the capital structure. Right, and nor can you lend to just AAA credits. So we have seen that some of the credit quality has deteriorated. There have been some folks at places like Apollo who have suggested, in the software space in particular, some of those bonds, some of those credits are worth 30 to 40 cents on the dollar. We've seen investors try to redeem from private credit funds, and they've been prevented from getting all their money out. There's typical gates that exist in some of those investment vehicles, and it's creating a sense of unease in the financial markets as to whether or not somewhere over the course of this year we might have an event. Again, relative to that, 2008 was a rather unique shock. If you remember, we were all levered to the same asset class at the same time, residential real estate, and then layered on top of that was an enormous amount of derivatives that were levered by the banks. And so we had a near systemic financial collapse, both domestically and globally. That's not what this is, as far as I could tell. This is maybe more like a long-term capital event where a individual bank or a couple of banks run into trouble because they've extended credit lines into the private credit community. You have a failure somewhere, and then you get a market event. Then the Fed would be forced to cut rates and kind of restart the process. So that's one of the things I'm keeping a very close eye on, because I do think that that's a risk going forward, that on top of all the other variables we may have to face somewhere down the road. Having said that, I will default to Warren Buffett's maxim that we come out of these periods, generally speaking, stronger than we go into them, and that the U.S. economy is extremely resilient. And there are a variety of positive things that are happening in the U.S. economy, whether it's artificial intelligence, whether it's venture capital, which is finding new uses for money that are going to enhance productivity, enhance efficiencies for businesses, that boosts profit margins, that keeps earnings estimates up, which they are this year, estimated to be 20% higher than they were a year ago, barring some unforeseen circumstances. And the U.S. economy, generally speaking, has always come out of moments of uncertainty stronger than in the past. Just a very quick anecdote. One of my first sources on Wall Street, Art Cashin, who was on the floor of the New York Stock Exchange since the early 1960s, was training during the Cuban Missile Crisis. And the instructor who was teaching these young men how to become stockbrokers and so on and so forth said, what would they do if the missiles actually flew? And to a man, they all said they would sell. And the instructor said, no, you buy, because if the missiles fly, there's no one to take your order, and if they don't, it's the buying opportunity of a lifetime. So when you're betting on the end of the world, you have to be right, because it only happens once, and even if it does happen, you don't get paid. So horrible way to look at the markets and look at the economy, which is that we don't usually have those experiences, and we come out the other side stronger. I know Ty's going to come up in a second. He's going to ask me some questions. He may ask me about the disastrous 3-year period in which CNBC forced me to wear a hairpiece. It is a true story. It is therapeutic for me to discuss it, and some of you may benefit from my experience as well. So I thank you very much for your attention this morning.